Why is the dollar crashing when it's supposed to be the world's safe haven during global chaos? A trillion-dollar question, literally. In theory, when the world panics, it runs to the US dollar. That's the rule. Wars break out? Buy dollars. Markets tank? Buy dollars. Pandemic? Dollar. Collapsing confidence? Dollar. But something's broken. Because right now, amid record geopolitical instability, spiraling inflation, and a tech sector whiplash, major banking giants are doing the unthinkable. They're moving out of the dollar. Traditionally, global upheaval boosts the US dollar as investors seek security. But as of March 2025, the dollar index, DXY, has fallen to 100.7, down from 104.9 in January, despite rising tensions in the Red Sea, economic instability in Europe, and ongoing conflicts in the Middle East. According to Bloomberg, the decline is being driven by a coordinated reduction in dollar reserves by central banks in China, India, and Brazil, each increasing their holdings in gold, euros, and Chinese yuan. Former IMF economist Stephen Jen told the Financial Times, "The dollar is no longer the only perceived port in a storm. The move is also supported by trade data. In Q1 2025, 46% of China's cross-border trade was settled in yuan, compared to 28% in 2020, according to PBOC filings. What's more alarming? This shift is accelerating not during peace, but during global crisis. The question is, what are they seeing that Washington isn't?" Since January, foreign investors have sold off $112 billion in U.S. Treasuries, according to the latest TIC data from the U.S. Treasury. Japan and China, the two largest foreign holders, led the pullback, reducing their holdings by $34.2 billion and $18.6 billion, respectively. Meanwhile, BlackRock has increased its exposure to European equities by 18% and trimmed its U.S. exposure, citing policy volatility and political risk. Credit Suisse's 2025 Global Investor Outlook notes that only 27% of institutional investors now consider U.S. assets most stable, down from 61% just 2 years ago. This isn't a panic. It's a methodical repositioning. Each move reflects a calculated loss of confidence in U.S. macroeconomic policy, and each withdrawal weakens the dollar's foundation a little more. But where is that capital fleeing to? Gold futures hit $3,057.31 per ounce on March 20th, the highest in U.S. history, as investors seek hard assets amid global currency recalibration. Meanwhile, the Euro Stoxx X 50 index is up 7.4% year-to-date, driven by a resurgence in German industrial output and increased demand for French defense exports. In contrast, the S&P 500 has seen net outflows for 6 consecutive weeks. On the other side of the globe, the CSI 300 index climbed 5.9% in March, boosted by a surge in cross-border settlements in yuan and tech sector subsidies totaling $42 billion, according to China's Ministry of Commerce. Economist Zoltan Pozsar, formerly of Credit Suisse, observed in a recent essay that global capital is signaling a reorientation of trust. The old assumption that global capital will default to U.S. markets is being tested, and the results are shifting in real time. U.S. consumer prices rose 0.6% in February, pushing annual inflation back up to 4.2%, with core goods like electronics and apparel showing the sharpest increases. The Bureau of Labor Statistics attributes much of the surge to elevated import costs from Asia. A new report by the Peterson Institute for International Economics calculates that tariffs imposed since 2018 are currently adding $1,430 per year to the average household's expenses. Despite Biden's criticism of the policy in 2020, most Trump-era tariffs remain in place and have expanded under Section 301 reviews. Oxford Economics notes that supply chain diversification has been minimal, meaning the costs are still passed on to consumers. While the original justification was to counter Chinese unfair trade practices, the actual outcome has been higher prices, limited alternatives, and reduced competitiveness, an economic boomerang hitting consumers squarely in the wallet. On March 18th, the Atlanta Fed's GDP Now tracker revised Q1 2025 growth to just 0.2%, down from an early February estimate of 2.1%. That projection coincides with the Conference Board's leading economic index, which has now declined for 22 consecutive months, a signal historically consistent with recession onset. Despite repeated denials from Treasury Secretary Lael Brainerd, who insists the fundamentals remain strong, key indicators paint a different picture. Freight volumes fell 11.3% year-over-year in February, while corporate bankruptcy filings are up 38% compared to the same period in 2024, according to S&P Global. Even Goldman Sachs, historically optimistic, revised its recession probability to 42% for mid-2025. If a recession is defined not just by contraction, but by eroded confidence, flat growth, and systemic strain, then by several metrics, the U.S. is already in one. The University of Michigan's Consumer Sentiment Index dropped to 56.9 in March 2025, below its 2008 low of 57.7, indicating deteriorating public trust in the economy's direction among lower-income households. The confidence reading fell to 43.2, reflecting rising anxiety about inflation, job security, and housing costs. The National Retail Federation reports that discretionary spending fell by 9.5% in February compared to the previous year. Analysts at Bank of America say their clients are pulling back faster than expected, with household savings rates now at 3.4%, just above pre-recession lows. What's driving the collapse isn't one factor, but the intersection of many rising prices, stagnant wages, unaffordable credit, and a growing belief that policymakers have no clear plan. And when belief disappears, economic behavior changes, not slowly, but all at once. In Q1 2025, U.S. exports to China dropped by 17.2%, led by a plunge in agricultural shipments, as Beijing expanded its grain imports from Brazil and Russia using non-dollar contracts, according to data from China's General Administration of Customs. But China isn't alone. In February, Saudi Arabia finalized an oil sale to India worth $2.6 billion, settled in rupees, marking the first time in nearly half a century that Riyadh bypassed the dollar in an energy deal. This shift comes amid coordinated government strategies. Indonesia introduced new regulatory barriers on U.S. fintech firms. Turkey has frozen approval of 3 U.S. defense contracts in favor of alternatives from South Korea and Qatar. And South Africa announced new procurement rules in March that explicitly deprioritize U.S.-made goods for infrastructure bids. According to a March report by the Atlantic Council, we're witnessing a strategic decoupling, not driven by necessity, but by design. That design increasingly aims to reduce U.S. leverage, one block shipment, one diverted contract at a time. After Washington raised Section 232 tariffs on European steel and aluminum in January, Brussels retaliated within weeks, imposing 4.1 billion euros in counter duties on a range of U.S. goods, from Kentucky bourbon to Boeing aircraft parts. The consequences are already visible. Boeing's orders from European carriers declined 22% in February, and Brown-Forman Corporation, the maker of Jack Daniels, warned investors of a 14% drop in European sales this quarter. EU Trade Commissioner Valdis Dombrovskis told Politico, "We will no longer accept asymmetrical trade pressures under the guise of national security." The broader fallout isn't just about goods. Currency demand is shifting too. With US.EU trade now increasingly hostile, more European firms are billing in euros or renminbi to sidestep exchange rate volatility caused by US tariff unpredictability. The dollar's strength has long relied on smooth transatlantic commerce. As friction increases, so does the incentive to conduct business without it. But this conflict may only be a symptom of a deeper vulnerability. Despite bipartisan calls to reduce reliance on Chinese manufacturing, Walmart still sources an estimated 70% of its consumer goods from China, according to company filings and supply chain audits reviewed by Bloomberg. In 2024, Target, Home Depot, and Best Buy reported similar exposure. with no major shift in sourcing despite tariff escalations. A Deloitte report released in February found that only 23% of U.S. firms attempting reshoring had reached full operational capacity in North America, citing labor shortages, factory backlog, and lack of raw material processing infrastructure. Meanwhile, China's manufacturing exports to Southeast Asia jumped 14.7%, much of it bound for the U.S. after superficial repackaging. Walmart CEO Doug McMillon admitted during the company's March earnings call that diversification is a goal, but not yet a reality. The U.S. can slap on tariffs, but the structural dependencies remain untouched. And if those links aren't replaced soon, the dollar's exposure to Chinese trade risk may prove more entrenched than any political narrative suggests. In a client note dated March 14th, Morgan Stanley cut its year-end target for the US dollar index from 102 to 89, citing weakening fundamentals and rising global diversification out of dollar-based reserves. The firm's FX strategist James Lord wrote, "Dollar strength is no longer a default assumption. It is now conditional on geopolitical restraint and macroeconomic coherence, both of which are in doubt." The note highlighted a simultaneous uptick in reserve allocation to gold and the Chinese yuan by over 30 central banks, echoing IMF data showing that the dollar's share of global reserves fell below 58% in Q4 2024, its lowest point since 1995. Morgan Stanley's downgrade isn't isolated. HSBC, Nomura, and Société Générale have issued similar alerts within weeks. This chorus of warnings suggests a broad shift in elite consensus. The dollar isn't doomed, but its supremacy is no longer taken for granted. And in markets, once belief breaks, contagion moves faster than reform. Scott Bessent, billionaire hedge fund manager and former Soros CIO, caused a stir during a March 2025 closed-door panel at the Milken Institute, where he reportedly said, "Sometimes the cost of global recalibration is domestic contraction." A recording leaked to Bloomberg shows Bessent elaborating. A mild recession could create the conditions for reshoring, energy autonomy, and reindustrialization if managed correctly. While some dismissed it as a theoretical hedge fund abstraction, his subsequent moves suggest otherwise. Bessent's Key Square Capital reduced U.S. exposure by 12% last quarter, while increasing allocations to Brazilian bonds and Indian equities. Former Fed Governor Danielle Tarullo responded publicly in the Financial Times, saying, "There is no such thing as a controlled recession. Playing with economic contraction to reshape global order is not just risky, it's reckless." The idea that the U.S. might be accepting short-term pain for long-term geopolitical gain is controversial. But if investors believe that theory is in play, they'll act accordingly, often faster than the policy architects themselves. By March 2025, at least 29 countries were actively testing or adopting non-dollar trade settlement mechanisms, according to data compiled by Reuters and the Bank for International Settlements. China's cross-border interbank payment system, CIPS, has now cleared over $14 trillion in cumulative transactions, up 54% year over year, while the BRICS Pay initiative announced new integrations with Turkey and Indonesia. Even traditionally dollar-aligned nations like the UAE and South Korea have begun testing bilateral digital currency swaps. The IMF's February working paper on reserve currency transition highlights a multipolar liquidity landscape emerging faster than historical precedent. Historian Barry Eichengreen warned in the Wall Street Journal, the loss of dollar centrality would not be an event, but a process. And we may be further along than policymakers acknowledge. The consequences are immense. Higher borrowing costs, inflationary imports, diminished sanction power, and eroded financial credibility. And if America is no longer writing the rules of global trade, who is? That answer may arrive sooner than anyone in Washington is prepared to admit. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.